Welcome to today's Explainer. We're diving into a really fascinating dynamic playing out in the financial markets right now. I like to call it the ripple effect. It's honestly incredible to watch how these massive international market waves, whether they're starting all the way over on Wall Street, out in the Middle East, or deep in the tech sector, are literally crashing onto Indian shores today. We're going to unpack the exact drivers behind this massive global surge, and more importantly, how it's setting up our domestic markets for a very, very significant reaction. So let's get right into it. And honestly, the proof is right here in this morning's headlines. Look at this. The GIFT Nifty jumped a whopping 170 points early Wednesday morning. It was trading firmly higher, which signals a huge, powerful gap-up start for both the Sensex and the Nifty. When you see a leading indicator like the GIFT Nifty pointing to an open well above yesterday's close, specifically aiming right for that 24,745 mark, it instantly tells us that something fundamental shifted overnight. Basically, Indian equities are poised for a tremendously strong performance today, all driven by this suddenly improving global risk sentiment. But to really grasp what's fueling all this investor confidence, we actually have to look outside of India first. So, here is our roadmap for today. We'll start with global markets hitting record highs, then look at geopolitics and plunging oil. Next, we'll see why Indian markets are poised to surge, followed by why all eyes are on the RBI policy, and we'll wrap up with the technical outlook and cash flows. All right, jumping into part one, global markets hit record highs, driven by the Wall Street and Asian rally. The sheer scale of the overnight rally is just staggering. Over in the US, equities absolutely surged. The Dow Jones climbed 1.71%, and the S&P 500 advanced 1.79%, both actually closing at fresh record highs. And the tech-heavy NASDAQ? It jumped an incredibly impressive 2.59%. But the wild part is, it didn't just stop at Wall Street. This momentum rolled right into the Asian trading session. Optimism has just lifted investor sentiment completely across the board. Japan's Nikkei 225 rose a massive 3%, and South Korea's Kospi gained 3.4%. MSCI's broadest index of Asia-Pacific shares outside Japan, up 1.5%. What we're looking at here is a totally synchronized global risk-on environment. But you've got to ask yourself, why did Wall Street suddenly decide to surge to all-time highs? Well, this wasn't random at all. It was heavily supported by some seriously strong quarterly results and raised outlooks from major corporations. Specifically, investor sentiment got a massive boost after AI-linked companies like Palantir Technologies, as well as industrial heavyweights like Caterpillar, delivered incredibly upbeat corporate earnings. Think about it. When companies of this sheer size not only beat expectations, but actually raise their annual outlooks, it injects a massive dose of confidence into the market. It basically proves that the underlying economic engines are still firing on all cylinders. Okay, let's shift to part two, geopolitics and plunging oil, as tensions ease in the Middle East. The catalyst here is an absolutely massive number. Crude oil prices tumbled more than 5% in the previous trading session. Now, for a major commodity, dropping 5% in a single day is a highly significant plunge. This sharp decline brought Brent crude slipping all the way down to $79.02 a barrel, while U.S. West Texas Intermediate, or WTI, eased down to $75.35. And here's the thing. For a major oil importing economy like India, falling crude prices are an absolute game changer. It's a massive tailwind that directly supports our domestic risk appetite. But what actually caused this sudden 5% drop? Well, it all comes down to a major shift in sentiment regarding the Middle East. Previously, the markets were just weighed down by these intense fears of a prolonged US-Iran conflict and the very real threat of global energy supply disruptions. But over the last 24 hours, the narrative has completely flipped. We're now seeing hopes of actual progress in negotiations to end the conflict, which significantly reduces those supply fears. On top of that, there's newfound optimism about reopening the Strait of Hormuz, which, if you didn't know, is one of the world's most critical oil choke points. This geopolitical relief is just a massive weight off the shoulders of global investors right now. Moving right along to part three, Indian markets poised to surge. We're going from profit booking straight to a gap up. The contrast here is honestly striking. Just look at Tuesday. Indian benchmark indices snapped a 4-session winning streak. The Nifty fell by nearly 160 points, roughly 0.64%, closing at 24,614. The Sensex dropped over 210 points. Investors were out there actively booking profits, playing it cautious ahead of the upcoming weekly derivatives expiration. Plus, there was some heightened volatility after the NSE rolled out its new closing auction session. However, fast forward to Wednesday morning and the picture completely flips. Thanks to all those global developments we just walked through, Wednesday morning's GIFT Nifty indicates a surge of 165 points. That means the Nifty 50 is expected to open right around 24,745, which would completely erase Tuesday's losses right out of the gate. Now let's get into part 4, all eyes on RBI policy. This is today's main event. So, this is the critical question. This is exactly what caused investors to pause and book those profits on Tuesday. Because look, while the global winds are definitely blowing in our favor, domestic monetary policy is the actual engine that drives local liquidity. The RBI's Monetary Policy Committee decision is coming out later today, and it is absolutely the main focal point for every domestic investor right now. And market participants aren't just waiting for a simple rate decision. They're closely monitoring 4 very specific areas. First, they want cues on the future trajectory of interest rates. Second, they are going to be dissecting every single word of the central bank's commentary on inflation, especially when you consider the recent volatility we've seen in food prices. Third, they're watching for any liquidity adjustments within the banking system. And finally, everyone wants the RBI's updated economic growth outlook. A positive or even just a balanced tone from the RBI across these 4 pillars, that could be the exact catalyst we need to sustain today's massive gap-up opening. All right, on to our final section, Part 5, Technical Outlook and Cash Flows, where we look at expert analysis and institutional money. To put a human perspective on all this data, let's look at this insight from Panmudi R., the CEO of Enrich Money. He points out that this optimism over a potential US-Iran agreement and that subsequent decline in crude prices has fundamentally strengthened the market's near-term outlook. But he also highlights a second, incredibly vital force at play here: sustained institutional buying. It's really this combination, favorable global geopolitics meeting cold, hard local cash, that is truly underpinning market sentiment as we speak. Building on that optimism, his technical structure for the Nifty actually remains highly constructive. Even with that bout of profit booking we saw on Tuesday, the setup is looking strong. Basically, the 24,600s level acts as a critical bullish trigger. A sustained move above this line, which, remember, the GIFT Nifty is already predicting for the open, really reinforces that bullish momentum. If that holds, the index could potentially be driven right up toward the 24,800 to 25,000 target zone. Now, on the downside, let's say the RBI policy disappoints or global sentiment suddenly reverses. Well, the 24,400 to 24,300 region is expected to provide some immediate structural support. So overall, the broader near-term outlook remains cautiously positive. And those crucial institutional flows we just mentioned, they are firmly supporting these technical levels. On Tuesday, even as the broader market was falling, foreign institutional investors, the FIIs, actually extended their buying streak for a 6th consecutive session. They pumped a massive 2,446 crore rupees into Indian equities. Now, on the flip side, domestic institutional investors, the DIIs, they turned into net sellers, offloading nearly 1,000 crore rupees to book some profits. But honestly, the big takeaway here is that these sustained foreign inflows continue to provide a vital, incredibly robust floor of support to the broader market, absorbing all that domestic selling pressure. Which brings us to the ultimate question for today's session. We've got record highs on Wall Street, we've got plunging oil prices, and foreign investors are just pouring money in. The stage is literally set for a massive surge. But will the RBI's commentary on inflation and interest rates add fuel to this global rally, or will their cautious tone act as a sudden speed bump for Indian equities? We have all the pieces of the puzzle, now we just have to wait and watch how the market digests the main event. Definitely keep a close eye on that 24,600 level on the Nifty as the day unfolds. Thank you so much for joining me for this explainer, and stay tuned to the markets.